analyzing financial statements. Our focus will be on chapters 2 and 3 of the textbook. As promised from chapter 1, the focus of this video is to serve as an additional resource, a supplement to your textbook. In chapters 2 and 3, we are going to focus on businesses, why they borrow, look at the types of businesses and the various forms that loans to these entities will take, and how those loans are structured. And we will end with a look at the life cycle. Yes, another look at a cycle of the business. And so one way to summarize our anticipated journey is that the borrower has financing needs, and we will evaluate what those needs are and structure the loan to conform to those needs, and then of course ensure that the repayment is consistent with the type of loan that is extended to the individual. I wanted to start with a recap of what we have done so far. In chapter 1, we looked at what analyzing financial statement is really about. And the conclusion was that it focuses on asking the right questions, because with the right questions, we would hope for the right answers. We also determined that the goal really is to better understand the business to which we are anticipating lending. Some of the principles would be appropriate even if we were doing another form of analysis. In other words, if we were looking to invest, some of the same principles that we employ when we are looking to lend would be similar. So the focus of what you are trying to do will determine the nature of your analysis. Each business has, of course, an operating cycle, which we discussed in chapter 1, which has to do with the length of time that it takes to go from cash back to cash. We also discussed that each business has an accounting cycle, which is a cycle that begins with determining if a financial transaction has occurred and ending with the financial statements resulting from all of these financial transactions. The financial statements, of course, the primary ones are the income statement, the balance sheet, and the statement of cash flows. We then said that the nature of each is driven by the type of business sector that we're looking at. So we are focusing on 6 different business sectors. They all have operating cycles, they all have accounting cycles, they all have financial statements. But what makes each of these unique is the business sector. So the financial statement, the balance sheet, for example, will have assets, but the composition will vary depending on the business sector. All businesses will go through the accounting cycle, but the specific transactions that are recorded in the various stages will be a function of the business sector. Same thing is true for the operating cycle. All businesses will have an operating cycle. However, the specific activities that make up that operating cycle will be different. So that's chapter 1. And now we're going to launch into chapters 2 and 3. Just to provide a perspective, I am sharing with you a study, a 30-year study, 1970 to 2000, that was published in 2004. And what this study did was it looked at non-financial institutions in the United States, in Germany, in Japan, and in Canada, and basically asked the question, what is the source of external financing for these non-financial entities, retailers, manufacturers, and so on? And you will notice that even though the United States, relative to the other countries that were studied, has the lowest percentage of bank loans extended to these businesses, the reality is that by far, bank loans represent the primary source of external financing for businesses in most countries. So yes, the United States does have the lowest percentage compared to, say, Japan, and there are some cultural concepts that would help to explain that particular scenario. But the point is that bank loans represent a substantial source of financing, external financing for non-financial businesses. Notice that when you combine that with non-bank loans, then we see that it definitely is over 50%. You would think that with all the talk about the bond market and the stock market, that these two markets would have represented larger sources of external financing. However, compared to non-bank, you can see that the bond market is slightly below that. And of course, when it comes to the stock market or the equity market, it is even less. So again, my primary reason for sharing this with you is to simply let you know that what banks do in conjunction with the non-bank public or entities represents a primary source of funding, external funding, for non-bank entities in various countries. So let's quickly go back to what we had discussed in chapter 1, which is the operating cycle. And we concluded, you may recall, that the operating cycle begins with cash and ends with cash. And there are two major parts to it, the holding period and the collection period. I also shared with you that the specific activities going from cash all the way back to cash will vary depending on the specific business sector. So for example, if it's manufacturing, they would focus on purchasing raw materials, producing the finished goods, and then selling that either all on cash or part cash or all on credit or part credit, and then collecting that cash, hopefully with a larger amount at the end than they had at the beginning. And during this period, they would be most likely needing financing. However, we could look at this in a little greater detail, and we would see that depending on the specific business sector, again, as I said in chapter 1, the specific activities are going to be different. This is called the cash flow cycle, and it differs slightly from the operating cycle only in the sense that it focuses strictly on cash inflow and outflow, whereas the operating cycle includes cash as well as the production or operating activities that result in the use of cash and the receipt of cash. So this one is focusing primarily on cash inflow and outflow and could give us a better sense of where the need for funding would occur. And so you can see the difference between, say, the manufacturing sector versus the retail sector. And what I'd like to do actually is zoom in a little bit on these two of those sectors to see exactly what we're dealing with. So here is a blow up of the manufacturing sector or a manufacturer. Let's assume that the manufacturer starts out with $1 and they use 35 cents of that dollar to purchase raw materials. They also use another 35 cents to pay for labor. So out of the dollar, they would have used 70 cents. And then they use another 10 cents for operating expenses. So from that dollar, they would have 35 plus 35 is 70 plus 10 is 80. They would have 20 cents remaining. And so they then sell the product for, let's say they're selling it for $1. So if they sold it for cash, of course, they would now have $1.20. But if it's sold all on credit, then it means that they would not be getting that dollar. So they only have the 20 cents remaining, and they're waiting now for that dollar to come in. So they would have started out with $1 and they would end with $1.20, assuming everything went as planned. That's a cash flow scenario that I just outlined for you. But what if instead of paying cash here, they purchase the raw materials on credit? It still would be funded, but it's being funded now by a credit purchase or a credit transaction. So they started out with $1, they purchased the raw materials, but they would still have $1. But of course, they would have a debt for 30 cents. Let's say they paid the labor. So now from the dollar, they would have spent 35 cents. They have 65 cents left. They paid for operating expenses and so on. My point is that cash flow is different from funds flow. So let me come back here and see if I can capture that distinction for you. In the first case, we started out with $1. We spent 35, we spent 35, we spent 10. Here, if we purchase the materials on credit, we still bought it, but it wasn't a cash outflow, but it was a funding that we received. And so the key distinction here is that when we're dealing with funds, it's not limited to actual cash in and out. It also includes funding. And the same thing would apply here. If we actually sold the item on credit, we are funding the customer. And so even though we did not actually write them a check for $1, the fact that we are allowing them to purchase the item from us, we're selling it to them on credit, we are actually providing them with funding. And so it makes a difference how the transaction is recorded. If it's cash, actual cash disbursement, then it's a cash flow. But if it's a credit, then it's regarded as a funds flow. The same thing is true for the retailer. In this case, notice that again, we'll start out with the same $1, and typical for the operating cycle, in this case, we're dealing though with the cash flow cycle, same concept, just to focus on cash. They purchase not raw materials now, but finished goods because it's a retailer, and they spend 50 cents. So they have 50 cents left from the $1, and then they spend 30 cents on operating expenses. So 50 plus 30, that's 80. So they have 20 cents remaining. And then they sold the finished product, or they sold the product actually, because if it's already finished, then there's minimal, if any, conversion required. And they sold it for cash. And notice, therefore, that they have abbreviated the cash flow cycle because now they have gone straight back to cash. Whereas if they had sold it on credit, there would have been a delay and therefore a greater need for funding. But the same principle applies. Retailers can sell on a credit basis. And so if they had done that, there would be a need for funding, because with the 20 cents remaining, they would now need to borrow, and the amount they need to borrow would depend on what it is that they want to do next. But all they have left at this point would be the 20 cents. And so if they needed to do any other transaction, they probably would need to borrow. But because it's a cash sale, notice that the path back to cash is much shorter. So as a general rule, we can say that businesses that operate strictly from cash will have not only a shorter operating cycle, but also a shorter cash flow cycle. So again, notice the difference between funds flow and cash flow. Cash flow is technically limited to actual cash in and cash out. Funds flow includes cash, but also includes credit transactions, because we're asking a slightly different question. How did you fund the purchase, or how did you fund the sale? And so the funding side of it is going to give us a bigger picture than us focusing entirely on cash flow. So when you talk about sources and uses of funds, it is a slightly broader caption than sources and uses of cash. So what are the typical sources of cash? Well, of course, cash itself would be a source. But notice that decreases in general in assets other than cash are considered sources of funding. For example, accounts receivable declines from $50 to $40. That's a pay down of $10,000. So that would be a use of funds because we are paying down the debt. Another example would be inventory decreasing from 60 to 30. That will be a $30,000 source of funds, as you can see indicated. And then we also can have increases in liability and equity. Those could also serve as sources of funds. Example, accounts payable increases from 40 to 50. That's a $10,000 source because it implies that the business acquired $10,000 worth of something on credit rather than use their own cash. So it is considered a source of fund. Equity would also be similarly captioned. If it went, say, from 100,000 to 150, that will be a $50,000 increase. And we would regard that 50,000 as a source of funds. Again, uses of funds, broader than just cash. So if your cash goes down, clearly that's a use of funds. But it's not just from cash. It could also result from increases in assets. Example, you sold something on credit and your receivables went from 40 to 50. So that's a $10,000 use of funds because we're actually allowing the customer to acquire the product or service without us having the receipt of the cash. So we are funding the transaction on behalf of the customer. Same thing would be true for inventory. Inventory goes from 40,000 to 60,000. That's a $20,000 increase, and it would represent a use of funds. We're assuming here that the change was not from, say, a donation or anything like that. And finally, decreases in liability and equity would also be classified as uses of funds. So stepping back for a minute and summarizing, what I'm sharing with you is that when we talk about sources and uses of funds, we are capturing a broader term than if we were to talk about cash in and cash out. Funds is asking you, how did you fund a particular transaction? Was it your money or someone else's money? And so we tend to capture more when we focus on funds flow as opposed to just the limited cash flow. Moving right along to the types of loans or financing that can be extended by a bank to its customers. You have 1, 2, 3, 4, 5, 6, 7 listed here, and we could actually expand this to 9 because the standby letters of credit, we could break this down into standby letters of credit, commercial letters of credit, revocable letters of credit, irrevocable letters of credit. But the two major types are standby letters of credit and commercial letters of credit. Let's go back up though and discuss them as they are listed here. So the first one listed is the special commitment. And this is going to be the type of lending that you provide if you have a specific situation. Let us say that you have a manufacturer and they just received a special rush order and they need to go out and quickly buy inventory, not inventory, but materials or supplies. They may not have the cash to do that because they just won this large contract. And so we could provide them with a special commitment to facilitate that particular transaction. And the repayment is going to come from the assets that were acquired based on the funding. So notice as you go through each of these that the repayment and the purpose should have some bearing on each other. So should the term. So that this is short term because we're funding a specific project, then the loan should be no longer than 90 days. Something else happens, then we can reevaluate, but the term should be 30 to 90 days. Basically short term, so less than a year would be the general rule here. Then we have what are called operating lines of credit, which would support, as the title suggests, the daily operations of the business, payroll, supplies, inventory, taxes, things like that. And of course, the conversion of assets, specifically current assets, to cash would be the primary source of repayment. By the way, you will learn in your commercial lending course that you should always have at least two sources of repayment, a primary source and a secondary source. So what you are looking at here in this chart are primary sources of repayment as opposed to secondary. So the secondary source could be maybe you took cash equivalent as collateral, but you want your primary source to be consistent with the purpose for which the loan was extended. And again, these are just recommended terms, doesn't address things like collateral and all of that, but in essence, the term should match the purpose. So you can see for the operating line of credit, we want to have it renewed annually because you have to reevaluate at the end of each year how the business is operating. And there may be a requirement for the business to be out of that line of credit for a specified period of time. We also have what is called permanent working capital line of credit. And I will share with you in a few minutes the difference between temporary and permanent. But essentially, your permanent working capital would be that portion of your current assets that is constant. And I will illustrate that on the next slide. So if you have a permanent increase in your accounts because maybe the company has grown, and so whereas in the first couple of years you were operating at $500,000 of receivables and inventory, you have now grown to 750, and so the 500 is the level below which you will not fall. We may need to provide you with permanent working capital for that level of operation. And so the repayment should come from excess cash generated from increased sales, because this is what caused the need for the increase. And so we should be able to get repaid, we being the bank or the lender, from that. Again, annual renewal would be the recommended term structure for this. Interest would be paid monthly, and the principal, of course, would be limited to collateral formula that the bank decides to use or that particular bank uses. There's also the seasonal line of credit, and again, the title suggests what it is. So maybe it's Christmas and the business needs to do special purchases that they would typically not be needing to have. And so we would want to provide them with that special seasonal line of credit. Sale of the inventory, of course, by the time the season is over, we should be able to be repaid. And so it should be short-term in nature. And as I said, you have your standby letters of credit and your commercial letters of credit. And the key difference there is one is used for international transaction and the other one is used for domestic transactions. Essentially, with a letter of credit, the lender is essentially providing their credit, if you will, in place of the company. So let's say ABC Business is buying a product from a company in another country. They're doing business for the first time, don't really know much about the business in the United States. Well, Bank of America, if that's the company that ABC is with, would say, you know us, we're Bank of America, we're not going anywhere. And so we are essentially putting our name, if you will, behind that particular transaction. And so they're guaranteeing the company in this other country that they can ship the item or items to the US company. And if anything were to go wrong, the Bank of America would step up and ensure that payment will be made for the inventory. And so we have the cash flow of the sale of the collateral would be possible sources of repayment there. And of course, this is usually unfunded, not unfounded, but unfunded until there is the actual need. So just because there is a letter of credit, it doesn't mean it will be drawn on. But if it is, then of course, we would structure that to be repaid. Until the letter of credit is actually used, the bank would normally charge a fee for making that letter of credit available. And then we end with term loans and leases. Term loan, of course, would be for longer periods. And so we're talking about acquiring assets that would have a longer life. So you wouldn't want to be giving a term loan to purchase inventory. You would want to be giving a term loan to a manufacturer to purchase new equipments, or an agricultural firm to purchase new machines, or a retailer to purchase new equipment. But it should be a long-lived asset, a fixed asset that is being funded with a term loan. And you can actually go between these two here, because there are times when the borrower may see it more advantageous to them, tax purposes and otherwise, to do a lease as opposed to a term loan. But essentially, these are going to be serving basically the same purpose. And again, just like we said, for all the other types of lending, the repayment, the source of repayment should reflect the type of loan. So if we're dealing with something that is going to be repaid over several years, then the cash flow from the operations of the business should be the primary source of repayment for such loans. Collateral, most likely asset, would be part of that. You will charge a fee, or you may not charge a fee, but you would require principal and interest payments to be made monthly, annually, whatever format the bank decides is appropriate. The specifics of this graph or this chart is going to be discussed in your commercial lending course. Just be aware, though, that for the different types of loans, your term, your repayment source, and the purpose should all be in congruence. They should all work together. You may recall that I mentioned permanent working capital versus temporary working capital earlier. Well, here's this graph that illustrates the difference between the two. First of all, when we talk about working capital, we're talking about current assets. And I know authors, such as the ones for your textbook, they use working capital and net working capital interchangeably, but technically they are not the same things. Working capital is just the sum of your cash, your inventory, your receivables, whereas net working capital is the sum of the cash, receivables, inventory, receivables and inventory minus your current liabilities. And so the net working capital, or NWC, is the difference between current assets and current liabilities, whereas working capital is just the sum of the current liabilities. So be careful when you're reading this, because there is a difference, even though your textbook, I think, does not make a consistent distinction between these two. Regardless, we can still get to the main point here, which is that there is a level of current assets that will always be there in the business, and that's the permanent level. And then there will be a level that will go up and down. When your sales are increasing rapidly, you purchase more, you sell, you purchase more, you sell, but there will always be that base level that you will have. And so the permanent financing would be for this piece, and then your operating would be for the fluctuations that occur. And so you may require that once a year, the firm be out of the line of credit. It's called a cleanup period. At least that's what I used to call it when I was in banking during my previous life. And that would be the point where they pay off the line of credit because their receivables would have been collected, accounts payable would have been paid off, and in addition, the cash that is left should be sufficient to also pay off the line of credit principal balance plus any interest. Last couple of slides here. This one is focusing on the different structures that businesses can assume. So we talked about business sectors, but now this is about business structures. Could be a sole proprietorship all the way through to an S corporation or a C corporation. And the decision as to how the business is going to be structured is going to be driven by things like the access to funding, capital, for example, liability, and taxes. Those are some of the factors that would influence the specific structure that the business takes on. Your legal department will guide you with regards to how you structure loans, depending on what the legal structure is for your client. Again, this is a focus more for commercial lending class, but just note that there are these varying structures that are available to businesses. Doing business as, which would be a slight variation of the sole proprietorship, but in most cases, we're talking about the same thing. And then you have the S corporation, which gives you the benefit of being a sole proprietor, but limits the liability because it has corporate status. And of course, your traditional business would be the C corporation, where you have stockholders, you issue shares, and so on. So spend some time going through this particular chart, noting the characteristics for the different types of structures. And then I end with the life cycle for a business. The actual length of the life cycle would be different for each business sector and what's going on in the economy. But notice all businesses will have a startup phase. They will hopefully grow, they will mature, and then they will decline. There is no precise length of time for each of these phases, but there are certain characteristics that will suggest the stage of the life cycle that a particular business may be in. I think it's safe to say that most businesses find it most difficult to obtain financing during this phase because there is just inherent risk. Most banks would prefer to lend at the growth stage, and of course, very leery to lend at the decline stage. So the length of time required to go from startup to decline will vary. For some companies that go out of business very quickly, say some restaurants, they don't even get through the mature stage. They go from startup to decline. But ideally, these are the 1, 2, 3, 4 major stages through which businesses will go over the life of that particular business. Finally, as I did in chapter 1, you make the call. First question says, which of the following correctly distinguishes an operating cycle from a cash flow cycle? And here are the options. I hope you will agree with me that the correct answer is that both the cash flow cycle and the operating cycle focus on the steps in the production, and that the cash flow cycle can ideally point to when funding is needed and so on in a much better way than, say, the operating cycle would. And last but not least, which of the following represents a source of funds? Remember, source of funds is different from cash inflow. It's broader. So again, you should agree with me that each of these represent a source of funds. If you're purchasing inventory on credit, you are using credit to fund the purchase. If you have accrued wages, it means that you owe your employees, so you have received the benefit of their services, but you haven't yet paid them. So your accruals would be another source of funding. Remember, the general rule is increases in liabilities would be a source of funds. And then delaying payment to suppliers, another way that you could obtain funding. So all of these are considered to be sources of funds, because when you delay, you are able to provide yourself with a relatively inexpensive source of funding. Of course, this can be a two-edged sword, because if you delay the payment to your suppliers for too long, then you may find it difficult to obtain financing, purchasing more from them in the future on a credit basis. Again, thank you for allowing me to provide you with this optional resource. Contact me if you have any questions.